Imagine losing a $2 million fleet of commercial delivery trucks.
Mm.
Like, not because they were stolen and not because your business went bankrupt either.
Right. But just because of a typo?
Exactly. Because a single data entry clerk accidentally typed Inc. instead of LTD on a digital form.
It sounds like a really bad joke. But I mean, in the world of commercial financing, a single keystroke can completely vaporize millions of dollars in collateral.
It's wild. Welcome to the high-stakes, entirely unforgiving world of commercial equipment leasing. We're so glad you joined us for this deep dive into the source material.
Yeah, let's put you, the listener, right in the shoes of a business owner for a second.
You've hit that magical tipping point, right? Growth is exploding. You suddenly need that fleet of trucks to handle logistics.
Or maybe you're outfitting a new medical clinic and you need $500,000 in specialized imaging tech.
Yeah, exactly. How does a business actually afford that without instantly destroying its cash flow? Because you can't just swipe a corporate credit card for an excavator.
You really can't. Most businesses just do not have that kind of liquid capital sitting around. So they rely on this hidden ecosystem of small business financing to bridge the gap.
The classic growth paradox. You need the equipment to make revenue, but you need the revenue to afford the equipment.
Exactly.
And unlocking that paradox is really our mission for today's deep dive. We are venturing straight into the heart of the Canadian commercial financing machinery as it operates right now, today, in the year 2026.
And we've synthesized a really dense stack of sources for you today.
We really have. We're looking at the Canada Small Business Financing Program guidelines, the Capital Leasing Pilot Project regulations, the notoriously strict Personal Property Security Act, the PPSA, and of course, the latest anti-entraying, anti-money laundering mandates.
Right, the ones that completely upended the whole industry last year in 2025. It's a phenomenal stack of documents.
Okay, let's unpack this. Because before a business can lease heavy equipment or sign some massive loan, the money has to come from somewhere, right?
Yeah, and lenders are notoriously risk-averse. They don't just, hand out $500,000 to a growing company without a safety net.
Right. And for you listening, understanding how this works is basically like getting the architectural blueprint to the economy's engine.
Mm-hmm.
Often, it's actually the Canadian government that steps in to be that safety net.
Because the government knows that if small businesses can't get capital, the entire economy just stagnates.
So they created the Canada Small Business Financing Act, or
Yeah.
the CSBFA.
Right, and it's specifically designed to help eligible businesses, which, by the way, the program defines as operations with gross annual revenues under $10 million.
10 million, okay. And the sources outline a maximum term loan of $1 million for those businesses.
Yes, and this is a big, but reading through the guidelines, it's far from a simple lump sum. It's heavily compartmentalized.
You can't just borrow $1 million and spend it on whatever you want.
Definitely not. Within that total $1 million limit, a maximum of $500,000 can be used for equipment and leasehold improvements.
Let's pause there for a second, just for anyone not fluent in commercial real estate jargon. What actually is a leasehold improvement versus like an intangible asset?
Good question. So, leasehold improvement is a physical alteration to a rented space to make it usable for your specific business.
Okay.
Imagine you rent a bare concrete unit in a strip mall, right?
Yeah.
And you spend $200,000 to install plumbing, dental chairs, custom lighting to turn it into a dental clinic.
Oh, okay. Those are the leasehold improvements.
Exactly, making the space actually function for you.
Got it. And what about the intangibles?
Well, intangible assets and working capital have their own sublimit of $150,000. These are, non-physical necessities.
Like software?
Yeah, exactly. Paying for proprietary software development, covering upfront franchise fees, or even stocking your initial inventory.
Right. And I also noticed a recent update in the sources from July 2022. On top of those term loan limits, there's now a $150,000 limit specifically for lines of credit.
Yes, to cover day-to-day operational costs. That was a huge modernization of the program to give businesses a bit more breathing room with their cash flow.
Makes sense.
We should probably also mention the capital leasing pilot project, though.
Oh, right. The separate lane.
Yeah, it's a much more restrictive lane. It caps the total financing at $250,000, and it's strictly for smaller operations revenues not exceeding $5 million.
Oh, wow. Okay. The eligibility rules caught my eye, too. Since June 2021, the government actually expanded the definition of an eligible small business
They did.
to include nonprofit, charitable, and religious organizations, as long as they operate a tangible business enterprise.
Which fundamentally changed the landscape. I mean, before that, a charity running a massive revenue-generating thrift store couldn't access this financing just because of its tax status.
That's crazy. It sounds like having a heavy-hitting, incredibly wealthy cosigner walking into the bank with you.
It does.
So wait, if I have a business, is the government essentially handing me a blank check to buy whatever I need?
If we connect this to the bigger picture, the government is absolutely not writing blank checks.
Right.
This is a highly regulated risk-sharing mechanism. The government isn't giving you the money. The bank is giving you the money.
Oh, okay.
The government is simply promising the lender that they will share the loss if you default. Specifically, it's an 85-15 split.
Meaning the government covers 85% of the eligible loss.
Right, and the lender absorbs the remaining 15%.
So the bank still has serious skin in the game. They're going to scrutinize the application because they don't want to eat that 15% loss.
They will scrutinize it relentlessly. And the program is strictly walled off, too. Farming operations. Completely ineligible.
Oh, really?
Yeah, they have their own entirely separate agricultural program. Same goes for holding companies and trusts because they don't meet the government's definition of an active operating business.
Okay, that paints a pretty clear picture of the initial hurdle. We know who's eligible, we know the amounts, but getting approved is just the preamble.
Very true.
Because the sources dedicate so much ink to the rules attached to actually spending that money. And some of these rules feel surprisingly restrictive.
Well, it's an ecosystem built on extreme compliance. The government wants to make sure this money is fueling genuine business operations, not, side hustles or real estate speculation.
Which brings us to the 50% rule for real property.
Right.
If a business secures a loan to buy a building, the lender can only legally finance it if the borrower uses at least 50% of the square footage for their own operation.
And that rule is completely non-negotiable.
See, I have to push back on this a bit.
Okay.
On behalf of our hypothetical business owner.
Okay, go ahead.
If I'm trying to scale my manufacturing company and I find a fantastic deal on a massive warehouse, but I only need 40% of the space right now, why shouldn't I buy it and rent out the other 60% to help cover the mortgage?
It seems logical, sure.
It's just smart, forward-thinking business. It feels like the government is punishing entrepreneurs for planning ahead.
I get the frustration, totally. But look at it from the public policy side. This program offers highly subsidized government-backed leverage.
Okay.
If they let you use that leverage to buy a building where you only occupy 40% of the space, you're no longer just a manufacturer. You're primarily operating as a commercial real estate landlord.
Ah, using taxpayer-backed programs to subsidize your investment property.
Exactly. The CSBFA exists to fund operations, not property magnates.
Okay, I see the logic, even if it stings. And I guess that philosophy ties directly into the 3-year rule.
It does. If you use this program to finance a property or leasehold improvements, you are strictly forbidden from leasing or subleasing your operational area within 3 years of getting the loan.
Though the sources do carve out a few exemptions, right? Like mini storage, healthcare, or hospitality.
Because in those industries, leasing space literally is the operation. A doctor buying a building to run a nursing home is obviously fine.
Right.
But if an IT consulting firm buys a building and immediately sublets half their desks to a totally unrelated graphic design company,
They're violating the term.
Exactly.
Here's where it gets really interesting. It feels remarkably like paying a highly regulated cover charge to get into an exclusive VIP club.
A VIP club, I like that.
Because there's a literal cost to entry. A 2% registration fee paid straight to the government, plus a 1.25% annual administration fee that the lender bakes into the interest rate.
Right, the cover charge.
You pay the cover charge, you get into the VIP booth with the great loan terms. But if you try to sublet your booth to someone else before 3 years are up, the bouncers throw you out.
The VIP club analogy works perfectly. You are paying a premium for access to capital you wouldn't otherwise qualify for. But, the club does offer one incredibly generous perk.
Ooh, what's that?
The 365-day rule for retrospective financing.
The retroactive window.
Yeah. Prior to July 2022, a business could only claim expenses made 180 days before the loan approval. But now, lenders can include eligible expenditures or commitments made up to a full 365 days prior to approval.
Wow, a whole year.
Yeah, which really recognizes the reality of starting a business. Entrepreneurs often have to drain their own savings to buy initial equipment or secure a lease, way before the bank paperwork is actually finalized.
So this lets them roll those out-of-pocket startup costs into the loan after the fact.
Exactly.
Let's pivot the perspective for a second. The business owner paid the fees, followed the 50% rule, and took delivery of, say, a $200,000 piece of heavy machinery.
Okay.
Now, I'm putting myself in the shoes of the lender. I just handed over a massive asset. The government covers 85% if things go completely sideways. But how does the bank protect its actual collateral?
Right. How do they physically take it back?
Yeah. How do they ensure they can get that machinery if the business just stops paying?
That brings us to the absolute bedrock of Canadian equipment leasing, the Personal Property Security Act.
Universally known as the PPSA.
Yes.
Reading the sources, it honestly reads like a highly complex legal game of dibs.
That is the perfect way to describe it. It's
Yeah.
exactly that. The PPSA is the legal framework that ensures a lender has a registered, enforceable claim against a specific asset.
Okay.
And to establish this claim, the lender has to complete two really critical steps. The first is called attachment.
That sounds like the private agreement part. Like we both signed a piece of paper saying the bank owns the machinery until I pay off the lease.
Essentially, yes. Attachment creates the security interest between the two parties once the value is advanced. But the second step is where the stakes become incredibly high.
This is perfection, right?
Yes, perfection. It's the act of providing formal public notice to the entire world that the lender holds a claim on this asset, typically by registering it on a provincial personal property registry.
And the sources emphasize just how unforgiving this registry is, especially for what they call serial numbered goods.
Like heavy machinery, commercial vehicles, IT servers, anything with a unique identifier. It demands absolute flawless precision.
Which brings me back to the $2 million typo I mentioned at the start of the deep dive. It genuinely boggles my mind.
It happens.
Are you telling me that if a data entry clerk at a major bank registers a massive fleet of commercial trucks, but misses one single digit on a 17-character VIN, or types Inc. instead of LTD for the debtor's corporate suffix,
Yeah.
the entire registration is just invalid?
What's fascinating here is, yes, it absolutely is.
That's insane.
The system is famously, ruthlessly based on form over substance. You could have a 50-page, flawlessly drafted legal agreement proving the bank's intent to secure those trucks.
That's the substance.
That's the substance. But the registry is essentially a digital search engine. The form dictates the searchability.
Oh, I see.
If a subsequent creditor searches the registry using the correct spelling or the correct VIN and your lens doesn't pop up because of a typo, the law considers your security interest unperfected.
Unperfected.
Yeah.
And what happens to the lender if they're unperfected?
It is catastrophic. If the borrowing business goes bankrupt, the bankruptcy trustee's entire job is to liquidate assets to pay off creditors.
Okay.
The trustee will actively look for those typos. If they find one, the unperfected lender loses their priority status entirely.
Wow.
They're stripped of their claim to the equipment and thrown right to the back of the line with the unsecured creditors. The bank could lose millions in machinery purely because of a misplaced letter.
That is terrifying for a lender. And the sources point out it gets even more chaotic because the PPSA is handled at the provincial level.
Oh, the cross-border complications are an absolute nightmare. Think about it. If a construction company leases a crane in Alberta and then just drives it across the border to a job site in British Columbia,
The lender's Alberta registration doesn't protect them anymore.
nope, it doesn't automatically carry over.
Yeah.
The lender has to navigate this whole labyrinth of conflict of laws, rules, and has a very tight, specific window of time to re-perfect their security interests in the new province.
And if they miss that window,
They become unperfected again. Open season for the bankruptcy trustee.
unbelievable. So the banks are deploying armies of lawyers just to ensure their paperwork survives a bankruptcy audit.
Exactly.
But the sources reveal that recently, the Canadian government realized they had a completely different, much darker problem lurking in this ecosystem.
Yes, they did.
They needed to ensure equipment leasing wasn't being exploited by organized crime.
We are talking about the sweeping 2025 anti-money laundering crackdown.
I have to be honest here. When I think of money laundering, I picture briefcases of cash moving through offshore casinos or anonymous shell companies buying luxury real estate.
Sure, the classic movie tropes.
Yeah. How on earth do you launder illicit funds through a forklift lease or a fleet of delivery vans? Walk me through the actual mechanism.
It sounds absurd until you look at the mechanics of a lease. Let's say an organized crime syndicate has $200,000 in dirty cash from, I don't know, drug sales. They can't just deposit that into a bank without triggering a million alarms. So they create a front company, a seemingly legitimate construction firm. They go to a leasing company and lease a fleet of bulldozers.
Okay, they have the equipment. Where does the dirty money enter the system?
Two ways, really. They use the dirty cash to make exorbitant regular lease payments, filtering the money into the legitimate financial system under the guise of standard business expenses.
Oh, wow.
Or alternatively, they sign a high-value lease, wait a few months, and use a massive influx of dirty cash to buy out the lease entirely.
Oh, so now they own the bulldozers outright.
Exactly. And then they turn around and sell those bulldozers to a legitimate third party.
And the money they receive from that sale is completely clean, documented, and fully integrated into the economy. That is incredibly clever.
It really is. And because high-value equipment leasing involves huge transaction volumes and complex financing structures, it was the perfect hiding spot.
It was just a massive regulatory blind spot in Canada.
For a long time, yeah. The lessors were just happy to be getting paid. They weren't legally required to ask where the cash was coming from.
Which totally explains the massive shift on April 1st, 2025. Van Track, the Financial Transactions and Reports Analysis Center of Canada, drastically expanded its mandate.
Right. Now, any entity financing or leasing business purpose property valued at $100,000 or more.
Or leasing passenger vehicles.
Yes, them too. They are now subject to the Proceeds of Crime, Money Laundering, and Terrorist Financing Act.
The PCM-LTFA.
Exactly. It fundamentally changed what it means to operate a leasing business in Canada.
Just looking at the compliance burden outlined in the sources, it looks staggering. They can't just pull a credit bureau and hand over the keys to a tractor anymore.
Not even close. These leasing companies were forced to completely restructure their operations. They are now legally required to appoint a dedicated senior compliance officer.
Wow.
They have to design and implement comprehensive risk-based assessments to evaluate the money laundering potential of every single client they take on.
Wait, reading through these requirements, they essentially have to act like financial detectives now.
Pretty much.
They're meticulously verifying corporate structures, verifying client IDs, filing suspicious transaction reports. If a client insists on paying a massive lease in cash,
And maintaining all of this detailed documentation for a minimum of 5 years
it's a huge burden.
is a brutal transition for the industry. The administrative costs just skyrocketed. Lessors basically went from being purely financial facilitators to deputized watchdogs of the federal financial system.
Let's pull all of this together from the perspective of the entrepreneur. For you listening, imagine you need equipment to grow.
Right.
First, you have to navigate the government's highly compartmentalized CSBFA limits. Then you have to endure the strict VIP club rules about how you use the property.
Yep.
You have banks demanding flawless PPSA documentation, and now you have lessors treating you like a potential money launderer, demanding exhaustive MTRAC disclosures.
It's a lot.
Attempting to navigate this alone seems financially suicidal.
Which is exactly why almost no business owner does it alone. They rely heavily on middlemen to bridge the gap between their business and the lenders.
But the sources issue a massive warning here. There is a critical difference between the types of middlemen operating in Canada,
Very critical.
and choosing the wrong one can actively destroy your ability to get funding.
Yes. We are making the distinction here between a general equipment leasing broker and an equipment leasing specialist.
The most shocking detail in the sources for me is that in Canada, the commercial equipment broker industry is entirely unregulated.
Completely unregulated.
Literally anyone can print a business card, launch a website, and call themselves a commercial leasing broker. No exams, no licenses, no formal qualifications required whatsoever.
It's the Wild West, and that lack of regulation leads to a really dangerous tactic known in the industry as the shotgun approach.
Let's define that for the listener. The shotgun approach is when an inexperienced broker takes a client's application and blindly blasts it out to 20 different leasing companies and banks simultaneously.
Right. They're just hoping that someone, anyone, says yes so the broker can collect their commission fee.
On the surface, an uneducated business owner might think, great, they are shopping my deal around to get the best rate.
So what does this all mean?
Well, if I'm the business owner, I might assume more applications equals better odds.
Yeah.
But reading the mechanics of how underwriting actually works, I don't see.
You see the flaw.
Every time that broker blasts my application to a new lender, that lender pulls my credit report.
Exactly.
So instead of taking a targeted sniper approach, the broker is firing a shotgun into the dark, and my credit score is taking all the shrapnel.
That is a phenomenal way to visualize it. Yes, your credit score is taking the shrapnel because every single one of those pulls generates a hard inquiry on your credit bureau.
And racking up a dozen hard inquiries in 48 hours.
It will severely damage your credit rating. It instantly makes you look like a high-risk borrower who is just desperate for cash.
And the lenders can actually see all those other inquiries on the report, can't they?
They absolutely can. And this is where the psychology of underwriting comes in. If an underwriter sees that this application has been submitted to 8 other institutions in the last 2 days, they assume it's a problem deal.
They assume the other lenders found some hidden flaw and rejected it.
Exactly. It creates this self-fulfilling prophecy of rejection. And even if you do finally get an approval, the lender will price it at a much higher punitive interest rate to offset the perceived risk.
Contrast that with the equipment leasing specialist. The sources describe them using a rifle approach. They don't just act as a mail forwarding service.
No, they curate the application proactively. A true specialist understands the nuances of the market.
Right.
They know that lender A loves financing healthcare technology, but absolutely hates heavy construction gear. They know lender B wants detailed cash flow projections, while lender C relies heavily on personal guarantees.
So they anticipate the underwriter's concerns and answer the questions in the application package before the lender even has to ask them?
Exactly. They submit it to 1, maybe 2 carefully selected institutions.
It really highlights a deep irony in this entire system. A brilliant business owner might have a thriving company. They might easily qualify under the government's CSBFA rules,
They flawlessly pass the intense Fiantrier background checks.
only to have their financing completely derailed by their own broker's sloppy shotgun application process.
It's tragic when it happens, but it's a stark reminder that critical thinking and aggressive due diligence are mandatory at every single stage of this journey.
The financial machinery works incredibly well, but it will grind you up if you don't understand how the gears turn.
It's a high-stakes engine. Whether you're a small business owner desperately looking to upgrade your operational capacity, or you're simply a listener fascinated by how capital silently flows through the world around you.
Commercial equipment leasing is the vital pulse of the Canadian economy.
It really is.
We've covered incredible ground today in this deep dive. We navigated the government's 85% loss-sharing programs and their strict operational rules.
We saw how a single data entry typo on a PPSA registry can cost a bank millions in bankruptcy court.
We explored the complex mechanics of money laundering that forced the 2025 FN Tracy crackdown.
And we exposed the hidden dangers of the unregulated broker market. It is a system built on decades of regulatory evolution.
Designed to balance extreme risk with the absolute necessity of economic growth. And as we wrap up, it leaves us with a truly fascinating, provocative question to ponder for the future.
Okay, let's hear it.
For you, the listener, consider this clash of timelines.
Mhm.
The government CSBF program allows a generous 15-year maximum term for these loans.
Right.
And the FNTRA mandates require lessors to rigidly keep records for 5 years.
Okay.
But think about the sheer speed of technological innovation happening right now. What happens when rapid obsolescence meets these slow, rigid government structures?
Oh, wow.
If a business uses a 15-year loan to acquire cutting-edge AI servers or automated robotics, and that technology becomes entirely obsolete in 24 months? How will these traditional decades-old financing structures adapt to the blinding speed of the future?
That is the defining tension of the next decade of commercial finance, because lenders rely on the physical asset holding its value.
Exactly.
When the asset becomes a paperweight in 2 years, the entire risk model has to be rewritten.
Because whether it's an MRI machine, a server farm, or a fleet of delivery trucks, the economy never stops moving, and neither does the invisible machinery that funds it. Thank you for taking this deep dive into the source material with us. We'll catch you next time.